Hello and welcome, traders. I am Rachel Deshelle, Senior Manager of Trading Services, and your host for this long options webcast. Now, this is a webcast where we focus on options buying strategies, and we make the assumption that you're already familiar with the basic concepts of options already. Now, if you're not, please feel welcome to stay around, but you may want to check out our Getting Started with Options webcast series first. Now, I am joined in the chat today by my good friend and colleague, Kevin Horner. Please feel free to chat in your questions, comments, requests during our session today. And please give us both a follow on X. I know Kevin and I post a lot of different market updates, charts, talk a lot about technical analysis on there, similar to what we do in these webcasts. So Kevin is Kevin Horner CS. I am Rachel-CS. So Kevin will put our handles there. And then if you find this video useful, please give us the thumbs up under the video and please subscribe to Trader Talks Schwab Coaching. Now, before we get started today, you'll notice I'm in a different location. I'm in Chicago. I'm live from the Schaumburg branch. So if you are watching and you are in Chicago, give me a shout out from the chat. Hopefully these clear skies stay around because there's going to be a lot of rain this week. So today we have a lot of new viewers possibly watching this webcast. So we're going to start again from the basics of long options, and we're going to discuss where to begin with long options. So we'll get into our agenda in just a moment, but I did want to pull up something else on our Trader Talks Schwab Coaching channel. So I have gotten a few questions, especially through those survey links, about where to really start if you are new to investing. So if you're a young investor, maybe an older investor that's just now getting started, just now finding investing, getting started in their journey, I want you guys to know that we do have a new to investing webcast, and I'll show you exactly where to find it. So Alex Coffey and I actually host this webcast every Thursday at 4 p.m. Eastern time. It's about a 20-minute. We'll find those sessions archived under playlists, and they are going to be right here, the fourth one in the new to investing. So essentially what this is it is an 8-part series where we just kind of started this series over again, but it's definitely a series that you can share with maybe your kids, grandkids, maybe a friend, colleague, coworker, whoever it may be that you know is a beginner investor and may need some help just kind of getting started with the basics. So wanted to cover that before we cover some of these important disclosures here. So getting into the disclosures, options carry a high level of risk and are not suitable for all investors. And the information that we're going to cover today is for general informational and educational purposes only and should not be considered any type of recommendation or advice. And keep in mind, we're going to go through the Paper Money software application today, but keep in mind there are some differences, major differences between paper and live. So for those of you that are new to our series here, this is typically what our agenda looks like. So we're going to start with reviewing some of our old trades. We're going to review what is going on in the major market indices. Then we're going to get into the meat of the session, which is discussing the concept of long options, when to use them, and discussing the concepts of price, time, and volatility and how that will affect your options price. And then we'll end this session by placing a few options trades on our Paper Money platform. So let's dive into Thinkorswim and start with that market overview. So we have had quite a bit of a sell-off the last couple days, but this is really the first real, I would say, start of a correction maybe that we're seeing in the S&P 500 since those late March, early April lows where we chugged higher for about, let's see how far we moved from lows to highs. We moved over 20% to the upside. And so right now, just in those last couple of days that we've seen from the highs to the lows, let's take a look at that. We're only seeing about a 5% correction here. So this is a pretty shallow correction, little bit of a pullback, price just needing to maybe digest itself through price rather than time at this point. So what we saw a couple days ago, we saw that break of the 20-day moving average, which you can see here with that middle blue line. This is the Bollinger Bands, for those that haven't seen these. We crossed that midline. We tried to rally back up to it. We did earlier today, and then we've actually crossed below that lower band of that Bollinger Band. So I know I just taught a session on this, but for those of you that are trend trading with Bollinger Bands, what you may be looking for is to possibly take a protective position or manage some downside risk when you see a break of that lower band here, especially since you're seeing the 20-day moving average and that lower band curving to the downside. That could tell you that we do have this short-term change in trend here, which further down finds support for right at that 50-period moving average, right below 7,200 there. So that 50-period moving average there is in orange. So that is going to be that next level of support in the intermediate term that traders will be looking at. Now, let's take a look at some of our past trades. So we have some of our past trades in this class. We had our Applied Digital. We had a 46 strike put there. We also had 100 shares of the underlying. We talked about this in our synthetics class. What this essentially is, it's a married put, but it also gives the risk profile of a long call option. So it's actually a synthetic long call option that we have on Applied Digital. So just showing you the chart of what Applied Digital looks like, and I'm going to take some of these indicators off of the chart so you guys can see the price quite a bit better. We talked about how we had this massive possible double bottom pattern or consolidation here. We've seen a breakout of that. We've seen a couple support retests. Now we're having maybe a little bit of a bounce today. So we're still holding on to that one. We still do have a little bit of time. Now, we also have Oracle as well. So Oracle was our leap option. A few weeks ago, we discussed trading leaps, and we looked at the 17th of June, 2027, 180 strike call. So we're up a little bit on that one as well. So those are kind of where our old trades stand. But we're here to talk about where to begin with long options. And one of the things that we do is we want to narrow down our universe of stocks. So we may want to look for stocks that are trading or trending in a certain direction, or we may want to look for stocks within a particular industry or sector that's showing some strength or some relative strength. And we want to narrow down our universe to maybe looking at stocks that are a little bit lower in volatility, so we're in a lower volatility regime. And we're going to talk a little bit about that as well. But I wanted to bring up one more chart before we dive in, because this will kind of give us a headline into what type of universe we are searching in today with these different stocks. And so you guys have probably seen this grid before on some of our other charts, I know, or on some of our other segments. I know Kevin Horner shares this a lot on his Trader Talks, but essentially this is a 6-month daily chart of all of the sectors versus the S&P 500. And so what this chart grid is showing is it's showing which sectors are showing relative strength. And so if the line is essentially going up, that shows that that sector is outperforming the S&P 500. If the line is going down, it shows that that sector is underperforming the S&P 500. And so essentially what relative strength does is it takes its ratio analysis. So you're just putting the sector or the stock in the numerator, you're putting the benchmark or that comparison symbol in the denominator to see if it's really outperforming that benchmark. And the reason why traders and investors use this technique with relative strength is because a lot of times when pockets of the market start to show relative strength, it's kind of an early precursor to a stock or an area of the market, like a particular sector, that may start outperforming on a absolute basis as well. So a couple things that I want you guys to note here. Notice a couple bottoming formations that are actually occurring within some of these different groups. You have tech that has rolled over from the highs. So we're not going to look at tech today because we can see that maybe that relative leadership, that absolute leadership is maybe waning a bit. Maybe we're seeing rotation into some other areas. We can see that recently the line has gone up in the real estate sector. We've seen the line recently has gone up in the financial sector. The one that has my eye is this healthcare sector. So for those of you that look at technical chart patterns, we completed this double bottom late last week where healthcare is now showing that improvement, that relative strength compared to the S&P 500. So we're actually going to take a look at a couple different healthcare stocks today. And we're going to talk through some of those things that I mentioned, like volatility. So one of the charts that we're going to take a look at is Dexcom. Now, this is in the healthcare sector. And I drew a couple lines on this chart because one of the first things that we're going to do is we want to understand the trend or the technical formation that this stock is building. Because with long options, we're paying a little bit of a premium, and that's going to be the most we can lose in this trade. But we do have unlimited upside. And the reason why is because this is a very directional trade. When you're buying options, whether you're buying calls or buying puts, you are waiting for a resistance break or a support break, or maybe a resistance bounce or a support bounce. Or maybe you're looking for a breakout of a technical formation. These are all different things that traders may be looking at to essentially trade a trend. So long options are very breakout based and very trend following based. So that's what we're looking for essentially here when looking at the charts to find some technical setups for long options. And so I showed this one as an example because we can see this larger bottoming formation. And for those of you that are in my trading price patterns class, please tell me in the chat what type of formation that you are seeing here, because I think it's pretty clear cut. We have a long-term basing pattern, which essentially is the stock moving from a downtrend, finding a low here, rallying up to a level of resistance here, going back down into retesting that level of support. It actually made a higher low in this case. And then now retesting that resistance and eventually breaking out of that resistance here. So what we're seeing here, which I see Chris put this in the chat, a confirmed double bottom. So we have a confirmed double bottom. You may be able to see it even better on the longer term chart. I know this is one of the things we talk about a lot in this class and other classes as well, to look at your trends on multiple time frames to get a context of what the long-term trend essentially is. So you can see just on the max weekly chart, this is a pretty large double bottom that has completed. You can see this weekly candle is breaking to the upside. So what we would be looking for, since we have had two closes above this level, we may be looking to take a long call trade in this scenario. Since we have had quite a bit of an uptrend, we've already seen our pullback or little consolidation here run under resistance, and then we had that breakthrough. And so a lot of traders, especially when getting directional with long options, we talked about looking at breakouts, looking at bounces to hop into the trend. And so what this essentially was this was a breakout. We have two closes above that level of resistance. Some traders may consider that a measure of confirmation. Other traders may look at a percentage filter. So they may look at a 2% break above resistance or a 3% break above resistance. So traders are going to wait for that confirmation before taking that directional trade. They then give them more conviction into that trade as well. So that's one of a couple things that traders will look for on technical chart patterns. Is they're going to look for bounces within that trend, and they're going to look for breakouts. And so that will give them, and then that filter of confirmation will give them that conviction to enter a directional trade. So that's number one. After identifying those pockets or sectors in the market that you want to look at. So we're kind of building on this where to begin with long options. So those are a couple different factors there. Another thing, we kind of mentioned it already, but I want to take a deeper dive into this and what traders tend to look at with long options is the volatility environment. Because when we are buying options, we want to buy into that option at a lower level, at a very compressed level, and we want to watch that price of the option move up to the upside so we can turn around and sell it for a gain. And so one of the major pricing components with options is going to be volatility. So options prices are going to be sensitive to those changes in implied volatility. So typically a long option trader may look for a stock with lower volatility or muted volatility is what we would call it. So right now, if you're looking at this implied volatility study underneath the chart, this is one visual way to look at it. I'll show you another way as well. You can see that this shows the implied volatility of Dexcom over the last year. And so you can see right now the current implied volatility is about 44%. And so if you look at over the last year, that's at a relatively low level. So I'm going to use the same thing as we would use on the charts by putting a little line here right across. And you can see how much of the last year was above that level. So we're probably looking at the lower third or so of the last year. And so each trader kind of has their own guidelines as far as what to look for. And we'll talk about that next. But one of the things we look for in this class may be an implied volatility percentile of less than a certain amount. So let's take a look at that next to expand this volatility discussion. So if I look at the trade tab, I navigate to all products. Underneath the options chain, you can see today's option statistics. Now, we went through this before, but if you look at the current implied volatility percentile, you'll notice that it's 31%. And so I was pretty spot on when I said that the implied volatility is probably in the lower third of where it's been over the past year, because this is essentially what the implied volatility percentile is telling us. It's basically taking all the levels of implied volatility that this stock has shown over the last year, and it's ranking where the current level of implied volatility falls on a 0 to 100 scale. So we're in the 31st percentile, meaning volatility is still pretty muted. It's still pretty low, which an options trader would say, hey, this favors a time to be buying options because the options prices may be a little bit cheaper because volatility is lower. So as the volatility goes up in the option, or as the volatility goes up, the options prices are going to go up because they're sensitive to implied volatility. So if on the flip side of this, if you are an options seller, you may be looking for higher levels of implied volatility, medium to high. And as a options buyer, again, we're going to look at lower levels of implied volatility. So a couple of different things that we are looking at there to make sure not only the trend is intact, not only have you seen confirmation, strength in that name or weakness in that name if we're looking at the puts, but we're also looking at the type of volatility regime that we are in. So the next thing we're going to do is we're going to talk about time to expiration. So a trader may look at a few different things. Now, a trader that may be trading this longer term type of formation may be looking at the entire time that it's taken for this double bottom to form, which is about 9 months. The longer term investor may be looking for options that are more than 9 months out from expiration. You could argue as well, if you take the second half of this formation, this could be forming a cup and handle pattern that it just broke out of. So this could be the prior resistance starting the cup, starting in March, and then just having this breakout now. So a trader may say, hey, well, it took about 3 months for that formation to develop. We may look a little bit more than 3 months out from expiration. Or if you're a shorter term trend trader and you are just looking to trade this trend, you may be saying that, hey, the price of the stock has used this 20-day simple moving average as resistance all the way down from this recent draft, and it's been above its 20-day simple moving average now for, let's say, the last month or so, or almost last month, last 3, 4 weeks or so. You may be looking for a shorter term trend trade in this case. And so you may be looking at a little bit more than a month out from expiration. So let's take a look at some of the options series, take a look at some other considerations when buying options. So we're going to go to the trade tab again. We're going to take a look at a couple different things. So if we're looking 2 months out from expiration, roughly, so this is a little bit more than 2 months out from expiration, this is really trading that intermediate trend, we would say. I'm going to collapse my left sidebar here. We're going to call a couple things to attention here. So when we're an options trader and we're looking to get directional, we want to take a couple of things into consideration here. And so one of them being, we want to look at time from expiration. We already talked about that. We also want to look at whether this option is that we're looking at is in the money, at the money, or out of the money. And so in the money options are going to have the background kind of shaded in this like purplish grayish color there. And essentially what that means is that option has intrinsic value. So essentially it would make sense for an option buyer to exercise their right on that option, essentially because the price of that strike price is trading lower than the price of the stock on that, in the case on the call side. So that's kind of just a recap of what that means here. Now, what that's also going to tell us is a little bit about our strike selection. So one of the things that we look at for our strike selection is looking at the delta. So we'll start there. And the easiest way to remember this is D for delta, D for direction. Delta is going to tell you what the price of the option will theoretically move with a $1 move in the stock. So if we just look at the slightly in the money option here at the 75 strike, we can see that this has a delta of 63 cents. And so what this is telling us is that if the price of the stock goes up $1 to 79.20, our option price is theoretically going to move up 63 cents. Okay, so keep that in mind. So there's going to be a trade-off, obviously, and we've talked about this in this class before. You're going to have your in-the-money options, or the options with intrinsic value. They're going to cost a little bit more because they have that intrinsic value. But the trade-off there is you have a higher probability of those options expiring in the money. So that's kind of another way that you can use the delta, is a higher delta, higher probability of that option expiring in the money. Now, you can look at an at-the-money option, which the at-the-money option would probably be the 80 strike. That's the one that the price of the stock is closest to. You can see that a couple different things on this one. At-the-money options are going to have the highest vega and the highest theta. It's theta, T for theta, T for time. So theta right here, this column, is going to tell you about your time decay on the option, which is very, very important when you're deciding your time frame as a trader and how long you are wanting to be in this trade. Because with options, especially when you're buying options, you have that important consideration that this option is going to shred value every single day. So as an option buyer, you're losing time value. So you need to keep that in mind when you are selecting your strike and when you're selecting your expiration date. So notice that with each passing day, you're going to have about 5 cents in time decay here with these at-the-money options. Now, if you look a lot closer, I'm going to show you how much this will increase over time. So notice the at-the-money option here. Well, I guess we'll still use the 80, even though they gave us some other slices. We'll still use the 80 because we were looking at that one. Notice that that time decay is more than 4 times the amount of the time decay that we just saw in that previous option series, because the closer and closer you get to expiration, you are going to have more and more time decay. This is crucial. So time decay tends to really kick into high gear, tends to kind of have that snowball effect of getting greater and greater at the 30 to 40 day mark out from expiration. So keep that in mind. If you want to hold an option for about a month, you probably want to look at 2 months out from expiration, because that 30-day mark is when things start to kick into high gear for your option there. So keep that in mind. Now, a couple other things. I touched on the Vega just a minute ago, but the Vega, V for Vega, V for volatility. This is going to tell you with a 1% change in implied volatility, how much that option is going to theoretically move. And this is why it's so important to make sure you're in the correct volatility regime for that option, because you're going to notice that the further that these options are out from expiration, the larger the Vega gets, because more time means more uncertainty, more room for the stock to move. So you'll notice that the at-the-money option is always going to have the highest Vega, and then you'll notice that the curve, the options expiration curve, you're going to have higher Vega, more sensitivity the further you go out. So this is basically saying that if we do have a 1% increase in implied volatility, our option is going to theoretically move up 14 cents in value. Now let's magnify that. So if we had a, let's say a 10% increase in implied volatility in this stock, you're going to see a $1.40 increase in this option premium here. So keep that in mind. Now, something with the at the money or out of the money options, you're going to have a smaller delta. So that kind of puts you on the fence of probabilities of, is this option going to expire in the money? Is it going to expire out of the money? And as an options trader, you typically want that option to expire in the money because it has intrinsic value. However, obviously most options traders will close out that option prior to expiration to kind of turn around and sell it for a gain. So the trade-off is going to be, do you want to spend a little bit more, have that intrinsic value, have more of a movement on the option as you would with a movement in stock, or are you wanting to just spend a little bit less of a premium and maybe just have a little bit of a movement on that option per dollar move in the stock? So those are always the trade-offs. But another consideration, and this is probably one of the biggest considerations too, is you're going to look at levels of liquidity. The number one measure of liquidity that you're going to look at is the spread on the bid and the ask. And so what we tend to look at in this class is we don't want a spread, bid-ask spread greater than 10%. So just kind of looking at some of these spreads, you can see that some of these spreads are greater than 10%. You'll notice that another way of looking at levels of liquidity is going to be volume, which is the number of contracts traded on the day, and open interest, which will tell you the number of open contracts. And there is sufficient volume in open interest, but the thing is that that spread, it may still be a little bit wide. So that is going to be another one of those factors that may sway your decision on the types of strike prices, because you don't want to look at, you don't want to have slippage. You want to have essentially a way to get a favorable entry for that position, also have a favorable exit for that position as well. So one of the things that we could look at, let's take a look at the one with 38, let's do the 45 days left till expiration. Let's see if there's some tighter spreads within there. Nope, you don't have a lot of volume open interest. Let's take a look here. Okay. Okay, so we are, I'm going to look at some of these other ones as well to see if we have a little bit of a tighter spread. Okay, this is one where we have a little bit of a tighter spread. We're going to look 101 days out from expiration, and this kind of tracks that time frame that we were looking at with the kind of right bottom of that double bottom pattern. Notice, remember how I called out that cup and handle kind of formation that we just broke out. So we're looking at a few months out from expiration. This is a little more than 3 months out. And notice that this spread between the bid and the ask is right around that 10% mark. So that's right around 10%. Don't have too much volume, have a good deal of open interest. This option is slightly in the money. We're going to go with this one and work from the midpoint. So what I'm going to do is I'm going to right click on this option, and I'm actually going to go buy custom, and we're going to use with OCO bracket. And essentially what this is going to allow us to do is this is going to give us our entry order which we're going to start at the midpoint, do a little bit of price discovery there. So that's the green order there, the first one in the sequence. Once that order gets a fill, it's going to trigger a one cancels another. So it allows us to put our profit target to the upside. It allows us to put our stop order or have our risk management to the downside. So what I'm going to do is link these all in as far as time in force. I'm going to make those all good till canceled. We have about $10,000 that we can put in any one trade in this class. So we can bump the amount of contracts up. We can say that, and I'll link these all together just to make it a little bit easy. Let's just say we can do 5 contracts. And I'm going to show you on the confirmation screen. You can see we're the most we can lose in this trade because we have 3 contracts. We would be controlling 300 shares here. The most we can lose is just under 4,900. So we're staying well within the risk parameters of our account, and we are not wanting to risk any more than 5% of our account in a trade. Now, we also use a couple rules as far as what our downside risk is. So one of the things that we want to keep in mind is that we do not essentially want to lose more than 0.5% to 1% of our account in a trade. So that tells us where we can place our stop. And so what we're going to do is we're going to place a stop here, and we are going to use, we're going to take 975, which is our entry, and we're going to say if the price of this option goes down 25%. Okay, so we're going to take 975 and we're going to multiply that by 0.75, and that's going to give us where our stop is. That gives us a stop at 7.31. Now you may say, hey, I want a little bit more space to the downside, because if you look at this, if you take the entry, which is 975, minus the stop, that's going to give us essentially what our risk is. So if I take 975, I subtract 731, that's a $2.44 risk. Now remember that we're controlling 500 shares here. So if I take 244 times 500, that's about a $1,220 risk. Now that still stays within the risk parameters of our account. So that still works for us here. So remember, just kind of do the math that way, take the entry minus the stop, calculate how many shares you're holding, and then if that exceeds that 1% of your account or whatever percent that you as a trader are comfortable with to manage risk, keep in mind that's kind of how you'll calculate that. Now, let's see. Okay, I'm keeping an eye on the chat as far as some of the questions that are coming through. Okay, and I see that Kevin's answered a couple of these as well. So now I want you guys to keep in mind with a stop order on an option when you are selling. A stop order on an option when you are selling. This stop order is just an activation price for another type of order. And this stop order triggers on the asking price of the option. If this was a buy stop, where we were buying back a short position and managing our risk if the spread widened, that would be triggered off the bid. But because we are selling this is a sell stop, this is going to say when the asking price of the option, so notice how high the asking price is. If the asking price drops to 731, this is when we want to get out of the option. We're going to use the market order. Now there's other types of orders there. Keep in mind, there are risks of the stop market order because that price of the stock could gap down overnight and you may not be filled into a very desirable kind of position there. So keep in mind that. Now we looked at our downside risk there. We have a 25% downside risk. Now some may look at risk versus reward when they're calculating these. Some traders may look at percentages. Some traders may not initially place a profit target on their option, but we're going to do that in this case. And we are basically just going to take 9.75 and we're going to multiply that by 1.25. we're going to say we're looking for a 25% return on this option. And so that's going to give us our profit target of 12.18 to the upside. Okay. So everything looks good here. We're going to review our order and we're going to hit confirm and send. You can see where our entry is, where our 2 exits are, and we're going to place this in our long options class and hit send. Okay, let me see what questions that you guys have in this class. Okay. How to account for slippage. So one of the major ways would be to understand the market and what you're trading. So looking for tight spreads on the bid and the ask. That's number one. Possibly using a different type of order other than a market order. So one way traders do this is using a limit order to have a little bit more control over their price. So that's what I did on the entry. Was I started my price discovery at the midpoint of the bid and the ask. And so I'm only going to get a fill if the price touches that point. So a lot of traders will use look for tighter spreads and use a limit order to account for that. I have another question about the difference between a stop, limit, and a stop. So just remember stops as just an activation order for another type of order. And so I'm going to show you what this looks like, because you'll see this on options and on stock. So if I look at order here, you're going to have stop, which notice when you select that, that shows stop market. That's just a standard stop. That means that as soon as that activation price is hit, you're sending a market order. Okay, so that's if you care more about the speed of execution than you do about the exit price. Now you also have a stop limit order. And so this allows you to put in 2 prices. Remember that the stop comes first, that's the activation price. The limit order comes second. And so what I see a lot of times, and I used to see this when I used to work on our trade desk years ago, and one of the major mistakes that traders made was putting these prices at the same price. And remember that the stop has to activate first and then the limit order is sent. So if the stock is moving down and it's a fast market, and you put these at the same price, you have to wait for the stock to come back up to hit that limit to actually be executed. So on the sell side, what a lot of traders may do is they may look for a little bit of a buffer between their stop and their limit, just to kind of catch that in a fast moving market. So you have to determine what a healthy buffer would be for you. But this is something that I do see a lot of traders using, because if that stop is hit and on the next tick, the price of the stock goes down, you kind of want your limit order to come in right below it, because a limit order says, I want this price or better. So when you're selling, it says, I want this price or higher. So if that limit order comes in a little bit below, it acts as a little bit of a buffer. So keep in mind, though, that if you have that limit order in and there is a gap that occurs in the stock overnight, maybe, it could blow right through that limit. So keep in mind, there are all risks with these different types of orders, but this one is where you care more about the price and the speed of execution. And then we obviously have trail stops as well. Trail stop markets, trail stop limits too. Okay. Let's see, any other questions? Okay, so I had a question. How do you know which price the stock will be at that 7-ish stop loss? Okay, perfect question. I get this one all the time. This is where you could probably, this will probably help with calculating your stops, calculating your upside. We use this quite a bit when we're actually setting limit orders to the upside on our options based off of the price of the movement of the stock, like if we're a target trader versus a trend trader. So what you're going to do is you're going to take this layout, we're going to change it from the Greeks. Notice my custom layouts down here. We're going to go to this Theo price mark, okay? And the Theo price mark will do that calculation for you there, Zinc. So if you take this Theo price parameters box, you can say, well, let's see, within the next week or so, let's see a week out from right now, if I wanted to see what the price of the stock would do if, or what the price of my option would be if the stock price went down $3 over the next week. You can also do volatility adjustments and things like that, but I put in a -3 to tell us if the stock dropped $3 in the next week, this would be the price of our option. So honestly, it would probably be more of like a $4 move. Let's see that. Okay, yep. So let's say the stock dropped down $4 within the next week. Our stop would likely trigger, or this would kind of give us kind of like a guidelines of to what may happen. Again, it's just a theoretical price, so there's nothing guaranteed, but you can play with some of these things. The mark is just going to show you the midpoint of what that option is now, and then you're going to have that theo price that calculates. So that this is a really, really neat tool to be able to use when seeing, hey, where can my option be stopped out, or seeing like where I should put my stop based off of moving up the stock price and things like that. So hopefully that helps. Now, we are just kind of rounding up this session today. We went in depth over really how to get started or where to begin with long options. And we're going to do a little bit of review. So we want to first understand the market environment that we're trading. We want to understand where we could have possible leadership. And so we started this, reminding you, we started this with this grid. And so, and Kevin just put that in the chat. Thank you so much, Kev. We noticed that we have some relative strength in healthcare. So there may be some breakouts, there may be some trends really kicking off their runs in healthcare. And so you can put in these filters within the scan tab to look in a particular sector or particular industry. Then we talked about identifying levels on the chart. So depending on your time frame, you could find these levels and then you could just shift down to different time frames depending on what your time frame is and adjust your option strategy accordingly. But we talked about how the number two thing is identifying those levels on the chart. And so we identified that this was a level of old resistance, now new support. We have that confirmation. With directional options, we want to look for confirmed breakouts and confirmed bounces, because essentially getting long options is a very directional strategy. And if we're being directional, we want to participate in the trend. We want to participate in breakouts. So those are the things to look for price-wise. Then we talked about where to begin with the volatility regime. We want to look, typically as options traders, we want to look for a volatility regime that is in kind of the lower bounds. So we showed a little bit of that. And then we're just pairing our expiration date with our time frame, what the technical time frame may tell us, and then diving into understanding the Greeks and understanding looking for levels of liquidity to avoid slippage and things like that. So that is your roadmap to where to begin with long options. Hopefully this helps. You guys know that all of these sessions are recorded and archived to our channel, and I'm going to pull up that channel one more time so you guys can see this. Okay, so I'm going to go back. We talked about the New to Investing series in the beginning, but all of our playlists or all of our webcasts that we host are all archived under this playlist section here. Now, you guys can hit that subscribe link for Trader Talks. Please definitely thumbs up this video today if you found it useful. Share it with a friend, whatever you need to do. But notice how all of these different webcasts are going to be archived under their own webcast name. So I just want to give you guys all such a shout out. Thank you so much for all your questions in the chat. Thank you, Kevin, for helping me out today. Please give him a follow on X. He is Kevin Horner CS. I am Rachel-CS, and we post tons of charts, technical patterns, all of the different things. So Kevin, please put your handle in the chat so that folks can catch you there as well. And thank you again, everyone. I will see you tomorrow in my Trading Price Patterns class. Take care and have a good rest of your day.